Podcast listeners, welcome to the Wealth Without Wall Street podcast, episode number 3. Wow, we're chugging along. Today we are covering some awesome stuff, including all lending ideas. Stay tuned. Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let the handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Here are your hosts, Russ Morgan, Joey Murray, and Will DeShazer. Wealth Without Wall Street listeners, this is Will, your money millinovator, and I am sitting here with your two hosts, Russ Morgan, founder of Everlight Financial, and Joey Murray, the stallion, aka real estate coach and founder of Blueprint Financial Partners. Guys, how are y'all doing this morning?
Doing good, Will. Doing good. How's everybody else doing out there?
Well, I can tell you what. Every time I hear the word stallion, I'm just motivated. I'm millinovated and motivated to be talking.
I'm sorry, that was a
money.
stutter. What was that?
Wait, is it millinovator, like an innovator, or a
like an innovative millennial?
I just want to see how motivated you are today when we hit the workout. I'm just
all right,
upset.
dude. Okay,
Joey, where are you on that, by the way? Why are you not in our class again? What was your excuse?
Okay. So just things have come up. I mean, things have come up, and all I'm saying is I'm tired of making you guys look bad in the class. And okay.
When you're in the class, you do definitely make us look bad.
Joey, you know the Tarantino,
as a group, we look worse.
You know the Tarantino movie Hateful Eight?
Yeah.
They're actually talking about Joey's dumbbells that he's lifting.
Come on.
It's the Hateful Eight.
Well, they are very colorful. I've noticed that.
That's ridiculous.
All right, we got to pull this back.
Hold on a second. Today, we're talking about lending. And what does that even mean? Because I've lent somebody money before and got totally burned.
Hey, but speaking of that, I do need to borrow some money.
How much we're talking here, and what are the terms? Yeah.
What are the terms? Okay. Well, I could give you plenty of examples, but we are going to be talking. Today's podcast is going to focus on lending, and more specifically, commercial lending. Bridge loans is something that we have implemented that concept into our practice, and we're going to go through how that helps you both whenever you're trying to create income now, but also whenever you're in a situation where you're trying to create income as a alternative to actually active income. But before that, I think it's important really to kind of give an overall view of lending, because lending is the one institution in the world that really never goes out of business, right? I mean, we are always in need of cash. Hence the reason the nicest and the prettiest of buildings in every town, regardless what town you're listening to this, is that the banks are always the biggest and the nicest of buildings. And what are they doing? They're lending money.
That's right. And just in light of what we've always been talking about in terms of money, is that there's this idea of becoming your own banker. And there's the reason is because it's so profitable, right? That you just mentioned how these buildings in all the downtowns are always the biggest when they're the banks. And it's because of leverage. It's because of utilizing cash, in many cases, someone else's cash, to create a return. And so I think it's so critical for people to understand this. We want to just cover some basic ideas, even share a couple stories of some failures and some wins, right? So
you will be mentioning some failures. I like to hear that because I fail each and every day. There's something to be said about learning from failures, right? So hopefully these guys may not do the same thing.
We're going to fail forward today.
Okay? That's going to be the hope.
That's good.
But we're looking, I mean, what's our purpose? Our goal is to get outside of the mindset of Wall Street, right?
That's right.
We've got to think differently, where really, if we're going to think differently, we got to think where are people with wealth putting money and what are they doing with it? And if we understand how banks operate and how they build wealth for themselves and their owners through lending, then I think we really need to dig into that. So let's start off real quickly with peer-to-peer lending, because that's become really, really hot of late, right? I think you've been doing even some research on one of the big crowdfunding lending institutions, Fundrise.
That's right. Yeah. And in fact, I can't pretend to be an expert in what they do and how they do it, but I can tell you that they're obviously turning some heads because they're just about to do their IPO. And they started out with a maximum of $10 million that they were going to raise. And in the first day, they had to put it on pause.
Wow.
They had that many people interested to buy. There were $5 a share. You had to have $1,000 minimum, but they had to up it to 15 million. And now if you go to their website, literally it says paused.
Well, so basically Fundrise is a crowdfunding source. What they are doing and where they've made their niche is they're allowing people with small investments as little as $1,000 to invest in commercial real estate.
That's right.
Which commercial real estate, historically, you've had to have large capital. Typically, and even in situations where we help our clients, they have to be accredited, meaning they have over $200,000 a year in income or $1 million in assets, and they have to put in a minimum of $100,000. Well, Fundrise and other institutions like them have made these small, what they call micro loans, where they basically group large amounts of people with small amounts of loans to go fund big projects. And boy, they have been, it sounds like they're doing unbelievable. You said that they had to pause and then they grew even bigger than that.
Yeah. And if you literally go on there right now, it says this thing is paused. So, what the future holds for them, who knows? Yeah. But I think the key to it is the barrier of entry is so low. And that's where I think, just to give you a couple of ideas. Again, some of these are good, some of these are bad, but there's always opportunities around that where someone may not fit the mold of just a traditional bank in the way of their lending needs. And so just recently I had a girl that runs a retail boutique and she needed to go to Atlanta to get, some inventory. She's waiting on a tax return. Okay. Now, some of you may be a little bit concerned to figure out what, like, lending has this kind of connotation in many people's mind of it's a little scary. Like, what if you lose it?
Seems like a risk, right?
Well, so are you taking collateral on the shampoo bottles, or where are we at on that?
This is not a Bed Bath & Beyond, is it?
Okay, this is going to be the first example of what not to do, okay?
Okay, so let's harp on that, what not to do.
Okay, the key to any lending is collateral. In this case, I had a little bit of a bleeding heart situation here. I'm not going to lie.
And how did you meet this individual?
Well, okay, so this is my gleaming hope here. Is she came as a referral from a very trusted friend who would have done it himself, but didn't have the money at the time.
He did not want to lend her the money. That's basically what happened here.
All right, y'all are going to have to stay tuned, okay? But I'm praying that I'm going to be able to share with you in a couple weeks how this was a great investment for me. However, it may totally bail.
So this is a peer-to-peer loan. This is where you're truly lending against nothing. And you're taking the word.
Okay, she's got a tax return coming. Okay,
that's right.
That's
tax
it's
return
in the mail.
It's a refund. Are we now betting on the government to pay off? They've never defaulted.
They're good for it. Okay, they're good for it.
That's right. Well, let's move into really what I would think would be a little more secure loan. Would be hard money lending. That's when we're truly lending our dollars against some hard asset. Like, for instance, this past year, we had an individual that came to us, a business owner in a kind of cyclical business where they were in the downturn, where they were going through the 2 to 3 month cycle where business was not quite as good. They had underestimated their need for money. They had a $30,000 asset, which was actually a Suburban. It was a new vehicle with title, and they came to us and said, "Hey, I need to borrow $10,000." And I have the title to my $30,000 car here.
Right.
So that would be a hard asset, something that if in the event of non-repayment, we could take title of. I've actually repoed cars. If you've ever watched any of my blogs.
Wait. mention that, because I think those are hilarious.
Well,
and what you used to do.
I went right out of college. My first job actually was working for a company called Enterprise Rent-A-Car. And I'm telling you, I was ruthless when it came to getting cars back. And there was times, sometimes you rent cars to unsavory individuals and you have to go knock on some doors. You have to go in some parts of town that maybe normally you wouldn't go into, but I'd go in there willingly and go get my car back. And I actually repoed a car from a Ruby Tuesdays on Sunday when the guy was pulling into work with my wife. So
wow.
Not as a repo man, as an enterprise branch manager.
Yeah. Well, I'm telling you, I'm all about the money, right?
So hopefully you guys are not going to have to be going and repoing cars.
No. But I knew that if I needed to pull that off, I could do it.
Right.
So The hard asset here, though, is what we're going after, is that typically we would tell people when you're in a lending scenario, collateral, collateral, collateral. How about
That's right.
second collateral? How about third collateral? Any way that you can guarantee that you get paid back either the cash flow or the capital through the sale of an asset if you had to go get it. That's where hard money lending is. And that's where last week we had a perfect example of that with a real estate group here in town who does hard money lending.
That's right. Yeah. So a group here that we've been able to partner with some of our clients, they want to move quickly, right? When they find a great piece of real estate, they know that they don't have 30 to 45 days to wait on a traditional loan to take down that asset. And they know that time is money, all these things. So they're willing to pay somebody 10% for the use of their money for a short amount of time. These are a lot of times flip homes, so 6 months, maybe 9 months on the high end, that they're going to borrow that person's money to purchase, renovate, whatever it might take, and they're going to give that kind of return back to somebody on the lending side.
And they're guaranteed by the actual real estate itself.
That's
right.
right.
So that's going to be a hard asset.
And Joe, you mentioned, and I think that group has mentioned to us, the money in realty is not made on the sell, right? It's made on the buy.
Yeah.
That's right.
Access to capital, having your warehouse of wealth in a place that you can access it, not tied up in Wall Street, that you can go grab it. I mean, that's huge. And that's exactly what these guys are doing with private investors.
Well, they're finding that, just you said, that opportunity is key. And as we move into really our topic for today, which is commercial bridge loans, it's exactly the reason why these things exist. If you go in and you look, a bridge loan is nothing more than a bridge between one transaction to the next. And what you find is there's investors out there who need to take advantage of opportunities. They find a piece of real estate, for instance, that's well undervalued, that they can take advantage of as long as they can move quickly. Well, traditional lending, though, as we all know, does not move quickly. You were in the mortgage world for 11, 12 years?
That's right. Yeah. And 30 to 45 days was probably a good day in commercial real estate.
Oh.
I was on the residential side, and that was, a normal turn time. People are okay if it's just a traditional sale, like retail kind of opportunity. But when you have the opportunity for a wholesale, like, hey, this thing is 30%, 40% potentially below value, they're not waiting on you to get the true appraisal and the title search and all these inspections and all these things that are required. I mean, cash talks in those opportunities.
They got to move quick. And that's why the commercial lending has come about from a bridge loan standpoint, is that you have investors who are identifying properties who need to act quickly, and they need to have access to capital. So they'll put in typically 30, 40% of their own money to the property, and then they'll go out and find secondary capital that they will be able to bridge that gap until they can go get the permanent financing at much cheaper rates. And so what we find is that our clients are looking for a safe place to put capital. And right now, I mean, again, if we're talking about Wall Street, the general Wall Street stuff right now, the fixed income assets, 2, 3, that's great returns for them.
2 or 3%.
I was about to say.
Oh, yeah. Whenever you think of, when you get into these bridge loans, you're talking 5, 6, 7. Those sort of returns are much, much different. And that is why they've become so attractive. So I want to talk about what a bridge loan is.
Yeah.
How does that work? Because there's going to be some questions people are going to have, like, how do I know I'm going to get paid back for this? What is my collateral if I'm putting money into these sort of things? So these are stuff that we want you to be knowledgeable of, because these are assets and tools out there that, if used correctly, can enhance portfolios. And they're really just nothing more than another lending opportunity. You're doing what other banks are doing.
And also, like we've said before, I mean, your return on information is so critical. So again, if we can increase your education around a subject, now the risk is severely reduced. And so again, lending is one of those things, I've heard this a million times. It's scary because there's just so little knowledge of how does it work? How do I get payback? All these, if you go to the FAQ sections of some of these different companies, they're full of these questions because people don't really teach this stuff.
But here's the key. And it goes back to, if you're going to do lending of any sort, you're going to start out with a promissory note. Don't try to write this up yourself. Get an attorney, and you can typically find a corporate attorney that does something like this in a couple of hours. So depending on their hourly rate, it doesn't have to be that expensive. But you can write up a promissory note that says exactly who is the lender, who is the borrower, what is the terms, what happens if they don't pay back on a certain day, what does the rate default to. You put in all these things. But see, the thing is, go read your credit card statement. Go read your mortgage. All of these things already exist for you. So it's not like you have to reinvent the wheel. And then what is the collateral backing up the asset? So in a bridge loan, for instance, a commercial bridge loan, they're buying commercial real estate property. So the actual property itself becomes the asset. Then oftentimes what we find in some of the relationships that we've built is that the actual institution that's doing the lending of the money, they're secondarily backing that up by their own guarantee.
That's right. And that just adds an additional layer of security, right? If you're trying to do this on your own, I will tell you, I would not do this on your own to begin with. There's a lot of potential pitfalls. Again, if you're not knowledgeable, that's when you start losing your tail. Now, I wouldn't have done this $7,000 loan I was telling you about if it was my last $7,000.
Sure. Well,
right.
But see, you've done some lending. I know this is not on the bridge loan stand. You've done lending on like commercially just from a peer-to-peer, but on like a mortgage.
That's right.
Other than a promissory note, other than the home, you're being on title and collateralized, what were some of the other safeguards that you did that if somebody's lending money, they need to make sure they're putting together?
Yeah. So you need to also think about what are the other losses besides the fact of that person paying or not. There's also let's say, disaster could strike. So for instance, on a house, you always want to make sure that you are on the homeowner's insurance as a payee. Because if something were to happen to that house, whether that, the borrower had anything to do with it or not, you need to be covered in the event of what you've got in it, at least. So making sure that you're on the homeowner's insurance is critical. The same thing with the car loan that we did recently. You've got to be on their insurance, their car insurance as a payee, because guess what? They'll forget about you in a heartbeat if you're not on those things, right?
Well, and you need to do title search too to make sure that there's not 5 other people out there with a lien against the car.
I had that happen too. Yeah. And I got all kinds of stories. Yeah. I mean, basically I had somebody tell me, oh yeah, this house is free and clear. It's $500,000 up here. I just need $100,000 line of credit against it. I said, man, that sounds like a pretty good deal. Just let me do my little research. I'll do the title search, and they have about $600,000 in liens.
But how did you do the title search, by the way, for someone who wasn't in the mortgage industry forever?
Now, again, this is on a residential property.
Yeah.
You can contact any local title company, and they will do that for you for a nominal fee, just especially as an initial search. Maybe $75, $100 for that. So very easy to find somebody that would be willing to do that.
All right. So bringing this back to commercial lending, bridge loans in specific, why would somebody want to put money and lend it in a commercial bridge loan? What would be some of the advantages that you're seeing, Joey, out there as opposed to other traditional financial products maybe they're putting their money in?
We've kind of beat the collateral drum for the most part here, but I think if you think about it, there's actually a physical piece of property that your money is tied to. Nothing. Wall Street, you got thin air. You've got numbers on a screen. You've got, paperwork somewhere that doesn't allow you to have any sort of tangible thing. I think that's why it's attractive. And people are looking for that now.
Well, and not to mention places to store money. I'm seeing in the millennial market, how exciting is a CD and a savings account right now? Like you want to talk about getting fired up, going to the bank, getting yourself a lollipop, leaving with your kid having a lollipop, and a nice money market or CD, right? That's doing it for people for sure.
I actually heard I went to a banker and I said, man, what are your CD rates right now? And they said, oh, we don't do those. We just tell people to leave it in their checking account. I'm like, what?
Great salesman. That's like me on a qualified plan. That's a great salesman.
Hey, well, I'm just saying, if you do want to start doing some lending, get some lollipops, because you're going to get families coming to that. Because I can tell you, every Friday when I'm driving around with the kids, they're like, Dad, let's go by the bank. I'm like, what do you want at the bank? Lollipop. Lollipop, Dad. Yeah.
It's the best thing they get.
Now my 11-year-old, by the way, this is interesting. My 11-year-old no longer gets the lollipop because she's now sitting in the front seat with me. And I guess they technically say if you're in the front seat, you don't qualify for a sucker anymore.
Oh,
Yeah. So she's being thrown out.
Hey, now
move her to the back.
I don't have kids, but I do have 2 dogs, and I was in the car a couple days ago dropping off a check at the bank, and guess what? Not a lollipop, but a dog treat. So step up your
What?
game in the peer-to-peer lending industry and get you some lollipops and dog treats.
nice.
And here's the thing: is that I know that if we're trying to find leverage, and we've talked about this, and we'll talk about this further, how we borrow against other assets that we
Oh,
own at
gosh.
4 or 5% interest rates, and if we could take advantage of things like this at 6, 7, 8%. Remember, it's not the difference between it. I mean, we just got finished eating breakfast with a commercial real estate investor, and basically he went into saying, in essence, his return on the investments that he has is pretty much infinite. Because really, at the end of the day, he puts very little, if any, of his own capital in it. And so the return of all dollars are infinitely returned on his capital. So if you invest borrowing money from someone at, say, 4%, and you turn around and lend it at 6%, your return is not 2%. Your return is 50%. It's 2% of the 4. That's 50% on your capital, because all you had outlaid was had to return back the 4%, but you got 6 from someone else.
Whoa, 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 whoa.
Did
Right.
that blow your mind?
Well, I'm just going to go ahead and tell you, a lot of people listening just heard you say 6 minus 4 is 2.
That's right. That's 2. But what was the cost for me? It's 50%. My return is 50%. What is the markup? So just think about it like this. This is where we go back to. If I could buy a hammer for $4, am I going to sell it for $4?
Not unless you want to go out of business.
Right. So I'm going to mark it up. What do you think the average markup in a retail store would be?
35. Oh, retail?
Probably 100%, isn't it?
It depends, right? So let's just say that I marked up my hammer 100%. So my return would be 100% if I sold it for what the markup would be. So what would be 100% of a hammer I bought for $4?
$8.
Why would the return not be 4 then? Why is it 100%?
Okay. You see what we just did there? We just went there. We just explained in a very easy way how you can leverage and create a great
I think they probably got it before you did, but that's fine.
maybe I'm the last one to
But that's
to the
exactly
party
what we
here.
do on this podcast. We challenge your thinking. That's what Wealth Without Wall Street is all about.
But okay, let's take this one step deeper. Think about the person who we're talking about. Why would people put money in bridge loans as an alternative to other savings and CDs? So you got a CD down at the bank at 2%, right? It's been there for 2 years. It matures, and you come back and they say, actually, we're lowering interest rates, and your return's going to go from 2% down to 1.5%. So you're no longer making the extra 0.5%. Is that a truth, or is that a lie?
I don't know.
If you were making 2% and they reduced the interest rate to 1.5%, did you lose 0.5% of your return, or did you lose 25% of your return?
There you did it again. You
Yeah.
explained it again.
This guy.
I'm learning, guys. I'm learning.
Yeah,
with you here.
his
This is
hands are in the
awesome.
air, and he now has a crown on his head. Those of you that are just listening.
But we need to think about that, because if you're in any shape of business, that's what you're doing with your dollars. Or if
Exactly.
you're working for a company, that's what they're doing. We need to think that same way. That's why we got to break free of this Wall Street mindset. We need to think differently. In order for us to create wealth, for us to grow our money, for us to be able to increase the lifestyles of those around us, we need to think.
That's right. I'm going to add to that. Okay. So a lot of people may be thinking, as they're hearing about bridge loans, well, what does that mean in terms of how long is my money tied up? There's mortgages out there that are 15 and 30 years. Do you really want me to tie my money up for that long? No. So why we like this idea of the bridge loan so much is these are 12-month maximum investments. So these lending opportunities,
There you
right? 12 months max. So it really is comparable to a CD or something along those lines, that you're tying that money up for a very short amount of time for a much, much higher return. So instead of a 1% or 2% CD, you're looking at 7%. That's dramatic. And I'm not losing access to that money for a long, long period of time. We're turning over inventory
Now, Joey, a lot of people out there are going to they really trust in this thing called the FDIC. Is this FDIC backed? What's going on with this?
I'm gonna step in for you, okay?
Please,
I'm gonna help you with that one. I know I saw the wheels turning, and the smoke was
subject.
The smoke was coming.
The
smoke was coming. The answer, Will, the short answer is no, and thankfully no.
Yes.
Because here's the key: is that most people don't know that the Dodd-Frank Act that was instituted a couple years back after the bailout of the financial institutions have basically said going forward the government will no longer bail out the FDIC, which has been done several times in the past, I think to the tune of $50 billion in 2009.
Wait a minute. You said they bailed out the FDIC. No, I thought you said they're bailing out the banks.
Oh, no.
Stuff like
No,
that.
the FDIC is the one supposed to be insuring the deposits at the banks, right?
Up to $250,000.
Yeah, but who is ultimately backing up to make sure that happens? Well, in the past, it was you and me. It was the taxpayers. Now, everybody goes to government, but we don't realize the government is us, right? We're the ones giving them the money. But now the new Dodd-Frank Act says, no, that will no longer happen. Now we will no longer have bail-outs. We will have mandatory bail-ins, meaning owners and creditors of the bank will now be the ones who have to support the lending operations and the transactional operations of the business. Well, we all know who are owners. Those are people who buy stock in banks. Would you like to have a guess of who the creditors of a bank are?
Let's think about that for a second.
The ones getting lollipops?
The ones getting lollipops.
Yeah.
So when we show up at the ATM to get the lollipop on Fridays and I make a deposit into the bank, the money goes into the little tube, goes and goes through that. These
things are amazing.
As soon as the teller, they're quite sucky. As soon as the teller gets that money, it's no longer my money.
That's a loan.
It is the bank's money.
Yeah.
Ownership has changed hands.
Absolutely, it's changed hands, and most people don't even think about it that way. But now I have become a creditor to the bank, and now in the event of a catastrophe, which I'm sure would happen. I mean, 250 banks haven't failed every single year for like the last 10 years.
Oof.
But in the event that they were to do that at a greater rate, the federal government has basically said no longer can the taxpayer bail them out. Those with money in the banks will be bailing them in.
Man, let that marinate for just a minute.
Don't, because this is supposed to be a happy moment. This podcast is not meant to make you sad. So let's go back to why are we looking at other opportunities? Let's take advantage of ways that we can actually create wealth for ourselves. And here's the last one I'm going to throw out there, because there's some of you who are entering retirement, are already into that phase. Or maybe you're sharing this with your parents who are trying to find ways to create income in retirement. And there's lots of financial institutional products that exist out there that try to fill this void. But right now, interest rates are really, really low.
Super
1,
low.
2, 3%. We've already beat that up, right? Well, how about if we had a product that didn't tie up our capital for more than 12 months, but did provide income to us at 6, 7%? Think about the opportunities that exist. So if you're in retirement or you're looking for that, bridge loans are one of these things you need to be looking into, because they really are filling the void. And remember, it's a win-win, because the person ultimately paying the interest rate on the other side of this is buying a piece of property at a very discounted rate, and they are benefiting off of it. They're making money. Now, they are absolutely wanting to pay back the property as quickly as possible so they can go get a traditional note at much cheaper. But for us, as the person lending money on the other side of this, it's become very popular. It's become something that I encourage you to seek out and look into as an alternative to Wall Street.
And for the income purposes, right? And I think just to kind of cover something very, very basically, but the Monte Carlo idea is that you can take off of a traditional.
Oh, no, Monte Carlo, that's what I used to drive when I was like in the 80s, right?
Yeah, we're not talking about that. I'm not lending against that thing.
The casino, that is.
But the Monte Carlo idea is that between 3 to 4% of that you can withdraw out of an asset and last the rest of your life.
Oh, you're talking about Monte Carlo simulations that are done by all these calculators that are basically saying that you can take out no more than 3 to 4% of your portfolio.
That's right.
Those Wall Street calculators.
Exactly. So What if
Okay.
you could double that? How much greater would your life look like in terms of your cash flow for the remaining of what you're trying to accomplish?
No, you're absolutely right. If you're interested in what he's talking about, there was a study called the Trinity study that actually went into the details of how much someone can withdraw against an asset and have it last 20, 30 years based upon a given market cycle using all those simulations. That's great stuff. Well, I think we've hit this. I think we've really drilled in on lending. And I do want to come back to stories in the future. I want to hear in a couple weeks about this,
Yes.
about the shampoo that you own. And I want to see, do you have your kids shopping this out on the corners, or did you get paid back the return just on the lending operation on it?
I will keep you posted.
Okay.
Well, guys, this has been Wealth Without Wall Street, episode number 3. And if you want, go ahead and check out the show notes. We're going to have a really, really awesome blog spotlighting a company that specializes in commercial lending bridge loans, giving you lending opportunities. And that company's name is Woodbridge. So we're going to have everything about Woodbridge in that spotlight. And do not forget to subscribe to the podcast. I mean, you're going to be able to hear about Joey getting a tax return from some woman and having shampoo traded back to her. That's ridiculous. So subscribe to this podcast, guys, for all things fun. But also, we're going to be teaching a little bit next week about something that the majority of our listeners nationwide are going to have no clue as to what we're talking about. And it's life insurance, but it's in a totally different perspective. You're really going to want to hear about this. This has been Wealth Without Wall Street podcast episode number 3, and we'll see you guys next episode. This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your terms in places you understand so that your wealth will never run dry. See you next episode.